Yes, it is. What is it? The second or third day of spring now, I think, right?
Yep.
Officially. So I got my golf hat on. We're all set to go. Okay. Although I still have a foot of snow on the ground, so not yet. We're getting there. Okay. So this week we welcome and a very, very warm welcome to Alan Masarek, the CEO of Avaya. We just don't have anybody on. We have the chairman of a multi-billion-dollar company on. We are very honored and privileged to have him on today. Of course, many of us know Alan from his prior stint at Vonage over the last few years and did some very significant things at Vonage. And I was a witness to several of them. So anyway, we're very excited to have Alan on and to share his insights and his vision as to what's going to happen with the company. So a couple of quick polling questions today. Okay, so let me start. So I'm just going to go right to the question. So, and these are really all in terms of what's the movement towards the cloud in the next couple of years. So how do you envision contact center deployments for small business in the next 2 to 3 years? 75% will be fully cloud, 25% hybrid, meaning over the top, or 60% cloud, 40%, or 50-50, or 25-75. Okay, please answer. And Scott Nagel, thank you so much. And Ginny for conniving Alan to participate today.
No conniving necessary, Steve.
Thank you, Alan. Okay, let me quick end the poll here. I'll take a quick snapshot as usual. And of course, I'll share the results, Scott and team, with yourself later. Okay, and here are the results. So for SMB, it looks like the winner here is 75-25, fully cloud, followed by 50-50, and then followed by, of course, 60-40, and then finally 25-75. Okay, let me hit you on question number 2 now. Again, I'll just launch it. How do you envision contact center deployments for larger enterprises, 1,000 plus employees, over the next 2 to 3 years? Same exact answers. Same exact choices. 75-25, 60-40, 50-50, 25-75. And Alan, you're now wearing glasses. I've never seen that before. Wow. Okay.
And I have no hair, so both these things. It's been a couple of years. It's not heading in a good direction for me. And what's left is turning gray. So
there we go. You're looking good though.
I appreciate it.
No problem. Okay, so again, let me just share the results here. I just took the picture, of course. So it looks like 75 cloud, followed by 50-50, almost identical really to the prior one. But it definitely shows that there is a movement towards the cloud. So third and final question, an easy one here. Why isn't this not polling? I can't launch it. I don't know why. Sorry. But we can, yeah, it's not launching. That is bizarre. It normally always launches it. Nope. Okay. Oh, I know why. Hold on. I got to get rid of the, sorry, one more. Yeah, sometimes it doesn't close it out. Okay. Here. Okay. No, it didn't do it again. Shit. Okay. Anyway, sorry. Okay. So let me just continue here. The last one was really more about, do you see a standalone contact center and UC solution where each are separate, or something more of a merger over the next couple of years? Okay, so sorry about that. I had a problem launching that particular one. Okay, so some quick preps before we have Alan on. But, many thanks to Claire Beatty and Ginger Conlon of Genesis. Fantastic results on customer experience and where the trends are in the market. Actually remarkable, considering that some of the customer experience trends are going down. And I think we all walked away with the idea that customer expectations are going up, and therefore we have to meet those needs with the new technologies coming about. So a couple of quick famous quotes. By 2005, it will become clear that internet's impact on the economy has been no greater than the fax machines. Okay. And that was a very famous individual who was Paul Krugman, who was an economist. Okay. And one more. Rail travel at great speed is not possible because passengers would be unable to breathe and would die of asphyxia. I love that one. And that was a Dr. Larder, who was a professor at the College of London in 1830. And of course, we bring all of these up because we are real believers in what they thought was real is really not real. And we can almost, broach this with another, question like, was Avaya going to survive from 2017? Well, we're all here to tell you, yes, it has, and it's back on the right track again. So this week, again, we're going to have Alan. Alan will give you the floor in a moment, and we just have a couple of quick things here. So Fletch, over to you for your infomercial. Let me keep going. And Fran, you're up for tomorrow.
We do have happy hour tomorrow, and with so many of us still stuck in winter, we're going to be talking vacations. What components are required for a successful vacation? So hope to see you tomorrow, and then we'll look forward to seeing you next week at Enterprise Connect. So let's gear up. So looking forward to it.
Excellent. Thank you, Fran. Okay, Dave Clardy.
Thank you, Steve, and
Sure.
Welcome to our Fireside Chat, Alan. Just want to remind everyone that next week is Enterprise Connect. Many of us will be at Enterprise Connect. And please join us for the happy hour on Thursday. A lot of great conversations come out of happy hour, and can't thank Fran enough for hosting it every other Thursday. That's it from the VAC. Thanks, Steve, and back to you.
Thank you, Dave. Okay, and Denise, our president.
Hi, everyone. I hope you're having a great week. For those of you who don't know me, I'm Denise Monroe, and I'm currently serving as the president of the SCTC. A couple things that we have going on this week. If you are going to Enterprise Connect, please make sure Barb Grothy knows you're going, so we can connect with you and, hang out or whatever. And please make sure you hit up all of our VAC booths and let them know you appreciate them and appreciate their participation in the organization. They are valued members of our association. Secondly, on this Friday, the 24th at 10 a.m. Central Time or 11 a.m. Eastern Time, if you're a consultant member, you should have gotten an invitation to our all members meeting. And this meeting is an important one because it is about a proposed bylaws change that the board of directors has recommended. And we want to have a discussion with you about it, give you some more details and information, and give you a way to ask questions and so forth regarding this bylaws change. So we look forward to seeing you on Friday, and hope everyone has a great time at Enterprise Connect. And thank you, Alan, so much for joining us today.
And we will have a great time at Enterprise Connect. So before we get started, Alan, I'll move your slides for you if that works for you.
Yeah, that works great.
Fantastic. So I got a couple of quick starter questions for you. So number one is, what made you accept this Avaya challenge several months ago? What enticed you, so to speak?
All right. And just that one?
Yeah, just that. Well, I got a couple more, but that's the first one. Yeah.
All right. So, truth be told, I sought this out.
Wow.
I have been, obviously through my bondage experience and before, I've been in this industry for a while, and certainly understood Avaya from within the industry, but outside the company. And it was clear to me that there was a transformational opportunity at Avaya. And similar to the experience at Vonage, where at the end of the day, it really was a product and go-to-market reset, and then organizational realignment and a cultural revitalization. I saw both of those opportunities here. Quite frankly, on an asset base, which is remarkable. I mean, think about the asset base. I mean, you have still one of the largest revenue bases in the space. You have a customer set, which is sort of the envy of the industry, the largest communication deployments, huge distribution footprint, 190 countries, 90,000 customers, huge IP portfolio, and a brand which is truly iconic. I looked at it from outside and I said, if I'm going to tackle another one of these big transformations, this is the one I want to do. And so the real story is, Hydrick and Struggles called me about another CEO gig, another public CCaaS company. And I said, I don't, and I just heard that there was a search about to be kicked off, and I said, I don't want to do that one. I want to do Avaya. And
Wow.
and the search guy, this is Heidrick and Struggles, he laughed. He goes, I just signed the engagement letter an hour ago. That's the God's honest truth. So, as you might imagine, given my experience advantage, anytime there was sort of a CEO shift in our industry, I was kind of I'd get that call for, to at least have those discussions. But this is the one I want to do. And while the financial upset, which I'm excited to share with you, is behind us, was greater than I thought. Now the opportunity really is very, very promising.
So let me ask you, what did you find when you first got there? And I know you will cover some of this on the slides, but what have you seen, that has changed in the last, 6 to 8 months since you've arrived?
So first of all, I had 2 open questions before I came. One was, how far along were they in the shift to cloud around contact center predominantly? And one, I was worried about the financing, and they had just completed that financing to get to take care of the near-term maturity that's due in June of 23. And so what I have found is, while clearly Avaya was late to the cloud, and we all know that, and in some measure, I think because these large implementations, they themselves are the slowest or the last group moving.
Sure.
But what I have found is the solution that's still in development clearly is architected well. It's probably already more scalable than most, virtually all competitive solutions. It's behind still in feature set, but what I've observed has been confidence inspiring, because if Avaya knows one thing, it is contact center feature.
Yeah.
The Elite solution is probably the most fully featured product on the planet, albeit a premise solution, but nonetheless, we understand contact center extraordinarily well. So our ability to burn down roadmap fast has been a good thing. The other thing is I never cease to be amazed when I get involved in these transformational projects that it comes back to sort of business 101 stuff. People fundamentally want to be led well, with a strategic plan that makes sense, that you can buy into, that you can understand how you can win. And that when you chase too many things and are not focused, which I think is an appropriate criticism going back several years, it's dispiriting the organization. So if you set things around a focused strategy, I think it's super encouraging to the organization. And even in midst of making pretty significant cost reductions in people and RIFs here, the Avians, I think, hopefully any of you have interacted with recently, there's a far better spring in the step than there was when I got here.
Oh yeah, I agree. Yeah, people are excited, et cetera. So let me hand the slides over to you. These were just a couple of introductories just to kind of get us started. But I'm sorry. Let me just hit you on one other one. No, I'll hit you at the end. Never. It's a good question towards the end. So
okay.
Let me go to the first slide. So again, these are your slides. Just an FYI, these Fireside chats are very interactive. I encourage anybody who's attending here, watching, to put your question in the chat bar so I can ask, of course, Alan. Okay, Alan, back to you.
All right, so big news in the red here today is the bankruptcy plan was confirmed about 45 minutes ago. So
wow.
We're done. Again, there's some administrative stuff. You'll probably see the order issued this afternoon or in the morning or something, but and there's some other regulatory things. But in terms of approving the plan's done. What we have achieved is taken a seriously over-levered company. We had almost $4 billion of long-term debt and long-term liabilities that have been reduced down to $800 million. From almost $4 billion to $800 million. And of that, with that almost $4 billion of debt, we didn't have a heck of a lot of cash. So as everything's been taken down to 800, the cash has increased. Actually, it's over $650 million. So you move from financial frailty to financial strength. I'm not sure there's anybody's balance sheet I would trade places with right now. And the mechanics of this, just so everybody knows, is the almost $4 billion of debt was written down by these investors to $150 million. So it's a debt for equity swap. They're saying, we're going to capitalize the company by virtue of washing away virtually all the indebtedness. So 4 billion to 150, we're then going to write checks for 650 more in the form of debt. So the 650 of new money pairs with the write down to 150. That's the 800 of go forward debt. But the 650 of new money is new money. So you're going to have more than 650 because you already had some cash. You have more than 650 of cash and aggregate debt of 800. And that debt is just, and it all combines together as a single, what they call a unitranche, just normal term loan. It's just one instrument. It's not due to the middle of 2028. So it's a profound change. That's a huge piece of the transformation. And obviously, as everyone knows, and I don't want to, minimize the point. When you do these massive debt to equity swaps, it's the common equity that gets, loses out. Now, our common equity value was, since I've been here, well less than, more like $50 million. So you effectively crunched $50 million of common for, basically billions in relief in terms of your net debt. But that is the give to get. And now the owners of the company are the investors and lenders. But the governance of the company is kind of like you'd expect it to be. So it's a 9-person board. The old board goes away. As CEO, I'm on the board. There's 4 representatives from the investors, 4 independents. And you just have a normal governance of a company going forward. Everything on the balance sheet restructuring, think of it as behind the curtain, forward of the curtain in terms of how we interact with every customer. It's all business as usual. And that the opportunity to make business as usual better, because now you're just a heck of a lot stronger financially. That's what we've achieved. On the right-hand side of this page is the cost structure. So in addition to this dramatic shift in the capital structure, we right-size the cost structure, and we've been very public about that. It's a little over a $500 million cost reduction, almost all of which is done. And most of it was done months ago. But with that cost structure reduction, you now have an almost immediate restoration of attractive levels of operating profit, of EBITDA. Remember, Avaya has always been profitable. It's had too much debt. So now we generate positive operating cash flow right out of the gate coming out of this bankruptcy. So we have low gross debt, very, very low net debt when you subtract the cash, and we're a cash generator. So when I think about the transformation, and again, I always hate when I have to do these things because I always talk like I sound like a CFO, and that's not my intention. I'm much more interested in the product and the organizational and people side of it. But from the kind of CFO's head, the transformation really, I've described it as 5 steps. The last steps were the costs and the capital structure, steps 4 and 5. But steps, 1 through 3, first was reset product and go-to-market strategy. 2, realign the organization. 3, revitalize the culture. 4, costs. 5, capital structure. So costs and capital structure, big check. The things that you can't sort of do, sort of in a moment, is the things that we struggled with from 10 years ago in being slow in our innovation roadmap. That's what we're fixing, and now we have the opportunity to do so, simply because now we, if we did everything operationally really well and didn't do the balance sheet and cost structure, well, you still have a problem. So you got to fix both sides. So let's go to the next slide.
So if I had a glass of wine or a glass of bourbon, I'd toast you, but I have my Lipton's iced tea at the moment. But congratulations on the announcement there. That's huge.
Thank you. Thank you. Okay, so those who know me, I'm kind of like, I just try to, I try to simplify things. And so when we got here, what we did is we've simplified the reporting structure. We have our software, we have our software, we have our hardware, and we have our professional services, which even professional services is more what we call hybrid cloud service now. We simplified that reporting structure, and then we align the operating structure internally behind that. So if you're going to report as software, hardware, and services, well, let's organize around it, and then let's simplify the offering structure under it. So let's go to the next slide.
Sure.
So we don't really have to double click into the offering structure about hardware and services. Those are pretty straightforward. But when you think about the software side, the software and support side, that's where you see a dramatic amount of change. And really what it distills down to is 3 sales motions and a limited number of SKU, what I like to call SKU families. So we're still selling prem. We're absolutely still selling prem. Remember, everybody knows this, but we have 90,000 customers who are prem, almost all prem architected solutions. But in certain sensitive industries, critical care hospitals, financial services, governmental agencies, geographies, it's just necessary. So we're still selling prem, that's one bookend. Then we have cloud on the other side, that's the other bookend. So full multi-tenanted cloud solutions around UCaaS and CCaaS. UCaaS, the Avaya Cloud Office, is a rebrand largely of RingCentral. And I'll come back to that. We changed that deal dramatically in this restructuring. RingCentral was a signator to the restructuring agreement. And then our CCaaS effort, because, well, we have rebranded it the Avaya Experience Platform. The reason we've done that, it goes to your one of your poll, the third poll that Steve, you weren't able to pull up, which is, I'm a profound believer and have been for many years that we should not think of our industry as silos around contact center, UC, and CPaaS, if you will. Whether it's CCaaS, UCaaS, and CPaaS, or CC and UC, it doesn't matter. In my opinion, these communication solutions have to converge, and ultimately, whether you are front of office agent or back of office employee, you got to be on a common system. And the elements of CPaaS, while obviously ran a big CPaaS business advantage, CPaaS, in my view, is an architectural approach. That solution needs to be extensible, it needs to be programmable, sort of built from a microservice architecture. Those are the elements of CPaaS, the way I think about it. And that's really the design, kind of the mantra behind the design in what we're doing in AXP. So those are pretty straightforward: sell prem, sell cloud. And again, the Avaya Experience Platform, we were late to the party. The company got really more engaged on building their own CCaaS, really the end of 19. So while we were behind, I've stepped into something that's certainly not greenfield. We're multiple years into it, and it's now getting a much, much greater share of development dollars and effort behind it to sort of burn down the roadmap ever faster. Now, the interesting thing here is the middle part. So you go back to the 90,000 customers, virtually all of whom are on a premise architected solution. Particularly the largest of those companies, their move to the cloud is more gradual. And the way we think about how we're driving that move, we've coined the phrase innovation without disruption. What that means at its simplest is we've got, as many of you know, we have massive deployments. I was at Bank of America the other day, it's 27,000 concurrent agents. I was just on the phone with a big bank in South Africa, 3,000 agents. And we have just tons, hundreds of these types of customers. for these customers, they want to avoid the disruption associated with taking out Avaya, battle-tested, bulletproof voice infrastructure that's been bespoke into, God knows how many things in your environment. They do not want to rip that out. The same token, they need modernize, obviously, think about chat, social, digital, whatever. And so ultimately it is a blend, it's a hybrid of the two. And so we're delivering that functionality, that over-the-top functionality via the experience platform itself, the Avaya experience platform. If someone wanted to buy the experience platform, the Avaya experience platform, I think of that as you buy the full meal. But if you only want to pull chat in or 2 social channels, wherever the heck it is, it's the roadmap of that. It's on the same platform, but we refer to that as AXP Connect. So it is think of that as not the full meal, it's consuming it a bite at a time. So you're pulling a tenant from that multi-tenanted platform down, pairing it with the core voice, which is premise-based. You can do that from a feature set point of view as part of your journey. There's also an infrastructure play. Many companies that we have, they're satisfied with the premise architected voice solution, but they no longer want to run it in their data center. The way I like to say it is they don't want to be in the blink and light business anymore. And so now we are moving that into Azure as our hyperscaler partner in a single instance or multi-cloud strategy. And then finally, we've taken our APS group and converted it into a cloud migration group, because their whole job is how do we manage the customer's journey without disruption, yet modernizing and providing the innovation. So that the way to think about it is, I never want to be in a situation where I'm creating so much disruption in the move from one to the other that it would trigger an RFP. Again, can I provide the value to the customer to keep you intra-Avaya? And I believe we can, because no one wants to go through the disruption, particularly among the large companies. And our competitors have set a different strategy. They've sort of said, we're de-emphasizing prem, we won't support single instance, and we're going to push everybody to the public cloud. And if my client base were different and smaller than it is, I might have done the same thing. But that does not make sense in my view when you have a client base like ours. And as we've road tested innovation without disruption hundreds and hundreds and hundreds of times with customers and partners and everybody else, it resonates. I just came back from I was at Converge One's conference here. I just got back a couple hours ago, last couple of days, and there are 57 customers there, and it resonates. So that's the strategy of the business going forward. We'll go next slide.
Yeah, sure. I also had a quick question, or actually just a quick comment, Alan, and that is, Blair Pleasant had done a fantastic job several weeks ago on customer experience and where the market's going. It's available for any of our members, of course, on replay. And she was talking about the, eventual convergence of UC and CC together, and more in the cloud. And actually, she's doing a session next week on it with a whole bunch of panelists. So yeah, she sees the trend. She's writing a lot about it at this particular point. Seems to be generating a lot of interest. And it's more of a future in the sense that she sees UC users having some of the features and functions of contact center that we don't see today. So it's kind of interesting, how that's going to happen. But again, that's available for replay. And Blair's session echoed what you just said. Okay.
It's interesting. My take is almost all of our corporate customers go through the same, with their customers and prospects go through the same journey. BDRs go outbound to prospects, turn some into qualified ops. Customers convert some of the ops into, salespeople convert some of the ops into customers. Customers come inbound to the agent. Account management goes outbound to the customer for upsell and renewal. Obviously, those interactions are all omni-channel, increasingly omni-channel, but they cross agent and employee. And so I just think there's an inevitability that these have to be ultimately on the same system. It's what the industry is doing, honestly. If you think, 8x8 with XCAS, with, Ring's partnership with Incontact, with, quite frankly, it was sort of Zoom's, acquisition that didn't go through with, with five nines. I mean, Twilio from CPAS moving forward with, Flex. I mean, it's just, I believe, the sort of the holy grail is around customer experience, and the smarter communication companies are going exactly there. And quite frankly, look at what Salesforce on the, they're moving from, you got to start from where you start from. They're starting from CRM. They're coming in big way into the communications. And look what Teams is doing. Obviously, you start from productivity, but going all the way back to Office and 365 and Link and Skype for Business, and now Teams, Dynamic, etc. It's inevitable, in my view.
Yeah, no question. In fact, I'll share with Scott later on. We had 2 polling questions all about customer experience last week, and on a 1 to 5, especially from the consultant's viewpoint, huge.
Yeah.
Oh, I'm sorry, I skipped a slide. Sorry.
That's right. I'm just real quick. This one's real quick. What we did is just by virtue of people get concerned all the time about, oh my goodness, Avaya has been late to the cloud. Yeah, we have. How do you fix it? Can't fix the past, you only fix the future. And so set our North Star on the experience platform unequivocally, rationalize things that we're no longer going to do. We didn't do a very good job of that in the past. We tended to keep too many products and projects and deployments methodologies. So everything became kind of a snowflake. And that, I don't care how big your engineering group is, it's just, you can't get anything done. So set our North Star on the one hand, rationalize through, end of life, end of sale, end of support decisions about half the, the older products and such. And like on the prem, we're still moving forward really hard with, the core enterprise solutions or Aura and, and Elite. And that's the, lion's share of it anyways. And we just got rid of the other stuff. So that's a big piece of it. And then go to the next slide. It's really when you were chasing too damn many things, what was happening is you had just redundancy everywhere. So what's so interesting is we've taken out about $520 million in costs out of a total cost base of just shy of 2 billion and haven't lost a nickel of profitable revenue doing it. That's kind of a stunning statement, but it speaks to kind of how gobbledygook you can get when you're chasing too many things. And so, focus, wins the day, in my opinion. This next slide, on slide 7, really tells a very, very interesting story, which is as we've cut the costs, there's a lot on this slide, but I just have everybody look to the bottom left, the little line on the bottom left. You know how everybody has subscription accounting and you can pull forward your revenues based upon a percentage of the TCV of a contract? It gets very distorted. So under 606 subscription accounting, you can puff up your revenues, and a lot of companies do that. But the cash doesn't lie. I mean, so you got to just track it from a billings point of view, money in, money out. And so if you look at where we had gotten, forget GAAP, but just look at it from a billings point of view, our cost structure in 2022, from 2021 to 22, had grown to 83%. Now with the cuts, it's down to about 71. When you're, over a couple $2 billion, that 10%, these are big numbers. And so the problem that Avaya had is go back to 2019, we were generating north of $300 million of cash flow, free cash flow a year. And in 2022, losing $300-ish million of cash flow. And it's like a ski slope between 2019 and 22. So that cost, restructure was a critical piece of it. So, all right, let me sort of jump forward. I'll go through the rest of this very quickly.
No, we got time.
Okay, so just slide 9, just so everybody remembers, Avaya has a very, very impressive footprint. And the way I like to describe it, if I think about Avaya as a set of assets, I would say I'm not sure any of us could go to the next slide. Sorry.
Sure.
not sure any of us could replicate this set, in one career. And it's a very impressive base. Then go to the next slide as well.
Sure.
And then just from a share point of view, major banks, 44 of the top 50, airlines, 10 of the top 10, insurance, 7 of the top 7, and so forth. We have a customer base, which is the envy of the industry. And look, I think we have, by virtue of not innovating fast enough, we have not been as strong a supplier as we should have been, going back many, many years. Yet they're still with us. And because there's certain things we do extraordinarily well, and things I think we did, far less well. We're fixing the things that we did far less well. And it's interesting when I reflect back. Here we were a company that was, this goes back many years, and you all know the company from many years ago, certainly better than I do. But we chased everything, too many products, projects, deployments, made it so that, we also flip-flop priorities a lot, flip-flop people a lot, technical people. So you're not burning down roadmap real quick. And so if you're not achieving roadmap very well, you become less transparent than I believe we should be. And even when we were transparent, we weren't reliable. We weren't hitting our dates. This goes back to a number of years. If you do that, you undermine trust. So, and all the while that was happening, and we were being perceived as more legacy, obviously we know what was happening in the broader communication market and all the high growth, cloud only guys, and this is a place their advantage was playing, we're obviously getting an outsized equity return and getting a lot of, sex appeal and juice out there in the market. So how do you fix that? Well, you fix it like I said. I mean, I believe, set your North Star on where you're going, rationalize what you're not going to do, be very focused so that you're burn down roadmap very quickly. But as importantly, be super transparent and super reliable. And so going back to November, we made the decision that we're going to start publishing roadmaps. And at a point of reliability that if I tell you I'm going to do 10 features in the quarter, by damn, I'm doing those 10 features in the quarter. So do that some quarters in a row, all of a sudden you're reliable and trust reemerges. I think we fell off the apple cart kind of over a bunch of years. It takes a while to regain that. There's no, not like a capital structure where the judge declared it, an hour ago that we're done. Not like that. This is just hard, tough, execution. But like in all our businesses, we all got to execute. That's why we come to work every day. And so we're doing that. I think we're doing it well. And now we have cost structure and capital structure to be able to pull that off. Flip over to slide. Actually, let's flip over to slide. Actually, go to 11 because I do want to comment.
Okay, yeah. So you're going to have to point me to the slide because I merged your slides with the other.
Right there. Here, perfect.
This one? Okay, great.
Yeah.
Fantastic.
So just real quickly on Ring Central. So obviously we have this long-standing relationship with Ring Central. So what we did is, first of all, Ring Central put $500 million into Avaya, 3.5 years ago when they did that deal. Some of it in the form of a preferred stock, which all got eliminated in this restructuring, and the rest of it in the form of a big contract advance for us to sell Avaya Cloud Office, which was a rebrand of Ring Central. So first of all, in the restructuring, every nickel that we owed them from the last deal all got flushed. So they're a signator of the restructuring, and there is no money owed back. There's no preferred share interest. There's no board seat. No, all that goes away. Now, the old deal was an agent deal only, meaning that when we sold ACO, it went on Ring's paper, and we were effectively paid a bounty, mostly a one-time bounty, not a lifetime bounty, a bounty that wasn't even in cash because we had received the cash years earlier in the contract advance, and all you did was, we receive $100 bounty, and it was just $100 reduction in the liability that we owed him back. The deal was very complex. It was just sort of a Frankenstein. I mean, it just didn't make a great deal of sense. And even with it not making very, very much sense and being terribly, terribly complex, we were the largest seller by a lot. And of course, all their distribution relationships. So one of the ways, so what we went back and said, we got to change this. So we washed all the liabilities away. And again, the leverage we had to do that is like, well, if you're not going to do it out of bankruptcy, I'm just going to have to do it in bankruptcy. So you're going to end up in the same place. So let's just do that. Let's do this out of let's do this in agreement with all the lenders and do this one time. So what we got now is we added to the agency deal that goes on their paper, we added a wholesale deal that goes on our paper. Because I think some of the reticence for us to bring ACO into our base was because you lose account control, because it goes on on Ring Central's paper. So now we have both models, agent and wholesale. And in the agent model and the wholesale model, we share in the lifetime value of the customer. So in the agent model, which still exists, they give us our cut for the life of the customer. In the wholesale model, we give them, it's on our paper, we have account control, we give them their cut for the life of the customer. But now it's also much, much more than just a rebrand of their MVP product, because part of the deal is an integration of ACO with AXP. Again, the fundamental belief that UCAS and CCAS belong together. And also an integration with Elite. So back in the day, we weren't selling the base very well because I think our salespeople were scared of losing account control. And if you did, the next thing Ring Central did was try to bring in contact to, knock out the Elite customers. So we've solved both those things. It's a much, much better deal. I think in effect, we've created an enormous TAM. And I think it'll be much better as a result.
So physically, what platform are you still using? The Ring platform, or are you using both now? Or what's your thought on that?
The public cloud solution is the Ring platform. So ACO, it's the same product.
Right.
ACO, if you look at it, it says Avaya Cloud Office by Ring Central. So it's the same product. The new stuff is the integration with AXP, which is unique to ACO, and the integration with Elite, which is unique to Avaya. So, but it's the same product. It's just now two go-to-markets. We can only sell the installed base. We can only use wholesale for the installed base. But that's the big TAM. That was the promise of the deal 3.5 years ago. It didn't really come to fruition that well, but I think because of the account control issues. Right.
And I know there's been some internal progress around integration with Teams, right? With Microsoft as a partner. So what are your thoughts on that?
So super, super important. I mean, ours is matter of fact, I'm meeting with some very, very senior executives at Microsoft here later this month, towards the end of the month. There's a very significant strategic opportunity here. So if you think about it, there's a lot of touch points, and it goes beyond Teams. So first of all, they are our hyperscaler partner. So we have a very, very large, kind of compute deal with Azure. We also, our number 2 alliance partner is Nuance, Verint 1, Nuance 2. So obviously Microsoft bought Nuance. 3 is, if you go back to our customer base and look at the top 2,500, the real monsters out there, the overlap with Microsoft, it's like the Venn diagram is completely just one circle. I mean, that's obviously the meat of their enterprise base, and ours as well. And then finally, it's how do we make the most significant integration with Teams possible, so that 1 + 1 = 3. And we have a lot of integration in there today, but we're working sort of a strategic deal to do ever more, because I think that's very powerful. I mean, I think Teams is, we all got to play with Teams. anybody who sits back and says, I'm going to defeat him it's ridiculous, in my opinion. So it's like, they're here and they're here to stay, and they're going to be a power. And so I think we're in a unique situation, by the way, because, others have sort of, like Google is more on the hyperscaler side, is more with, I think, UJet, and I think Five9s, and I think Genesis is more with AWS. So there's sort of this opportunity with Azure, and that's where we are.
Excellent. Okay, great.
All right, let me just flip through real quickly. Just last thing, just go to the next slide with the one more here. Just real quickly, just everybody knows this story. I just said I voiced this over, but if you go to the far right, this is where I think the world is going. I don't see it as separate UCaaS, CCaaS, and CPaaS. I haven't for many years. I see it as an integrated solution. I think the integration of CRM, that's obviously where you sort of store the, the version of the truth of that whole, omni-channel interactions from prospect to customer. That's where we're playing. So what I've shaded, this is when I talk about the experience platform, this is where we're driving. This is the, kind of the mantra behind the design. So I think anybody who sits back, particularly in the communication side, and wants to play in one versus not the others, will be left behind. Anybody who wants to play in one modality, I'm just voice or I'm just video, they'll also be left behind. I think you've got to get to this. To me, is the kind of the holy grail, in my opinion. And then last slide, if you could flip to the next one.
Okay. Hold on.
Yeah, or actually, I will.
Nope, hold on. I lost it. Hold on.
Okay.
Sorry.
Actually, I do have a couple more. I just want to.
Okay, no, that's fine. Go ahead.
Yeah. So here is this is data. I can't remember who did this, is Piper or something like that. But when you guys were doing the poll a little while before, this is the who did this? Piper? Yeah, Piper Sandler. It basically says by 2026, it's kind of half CC, half CCaaS. Where I don't have the data is if you resplit this based upon large companies versus small, because my supposition, different than the poll answers, I was surprised by the poll answers, is the large guys are still going to be on-prem longer. I'm not saying forever, but just longer. And which means there's just a hell of a lot of TAM there to play in. The world's going to cloud. I'm not, dismissing that one iota, but we've set our strategy the way we have because of the nature of our customer base, and this data supports it. Let's just move. I thought, because this is a consultant group and you're asked to comment about our viability all the time. These are just throw some numbers in here if I could.
Has anybody really asked you that question recently? I'm kidding.
Okay, so I throw this in because these are the actual, these are public documents. So when you go through this restructuring process, your long-range plan, your 5-year plan is part of the documents. This is a public document. Matter of fact, anybody who wanted to know more than you'd ever want to know, I think, about Avaya's restructuring, you go to avayarestructuringinfo.com, and it's, all these numbers, everything are in there. I show this because, and again, I look at the row C on total billings. We tend to, internally, we call it normalized revenue. So it skins out all the noise from the this point in time revenue and subscription and things like this. And the punchline is you get here in this current year, you're about $1,880,000,000. And between the $1,880,000,000 and 2027, you get about $2.6 billion. It's about a 14% growth rate on the software side. Overall is about a 10% growth rate because hardware is going to shrink, not grow. Your profitability from an EBITDA point of view, 14 to 24%. For years, Avaya was doing mid-20s. So this is not Herculean from an operating profit point of view. Matter of fact, I think many legacy software companies are printing presses, quite frankly. You sort of, you pull the money out of the legacy and you invest in the new. We just did a lot of other scroogey things that I think messed us up, but the opportunity to generate a lot of profit is really there. So the punchline is Avaya will be here forever. I mean, we are very strong. And I think this plan is very clear. I'll go to the next slide.
Sure.
Within this, the breakdown in that is the same numbers in the previous page. In the dark blue, you can see the software side, it will be almost 90%. It's already, 76%. It'll be almost 90% because its hardware is declining. And the software and sports side is about a 14% growth. Go to the next slide. So now it'll break down the software side. So of the software side, which will be 2,275,000,000 of that, just shy of 2,000,000,006. 90, well, the punchline of this thing is we will have premise software under subscription, we do today, and we'll have cloud software under subscription. And to a much, much lesser extent, we'll have premise under old perpetual license, but for which the subscription element is a maintenance, not a software subscription. For too many years, in my opinion, as an industry, we've sort of, if you could put everything on a bumper sticker, we've sort of said premise bad, cloud good. And I don't buy that. I don't buy that, particularly for this customer base. The way I think about it is, how do I have my customer base on the products that they need and want under long-term contract, under a recurring long-term contract relationship? And that's precisely where we're driving. So while increasingly these guys will be on cloud, either elements of AXP or the full AXP or what have you, it is you're going to have folks under long-term under your typical 3-year contract, which gives us stickiness, high earning power in a category with an enormous TAM. And I don't think of the TAM, by the way, as CCaaS. I go over, the TAM, the CCaaS TAM is like 11 billion. I go over to the customer experience TAM, which is like 25, because that's where it's going. And so my view is that's where we're headed. And by the way, last word, I'm going to shut up and open for questions. But why would investors and lenders write off almost $4 billion in debt and then put in $650 million of fresh capital? Everybody's an economic being. Why the hell would you do that? The reason you do that is you believe in the equity return. And you don't have to look very far to look at the competitive set in CCaaS, where I think all the value is. I think UCaaS is getting increasingly commoditized. So in the CCaaS side, in the experience platform, look at where Genesys raised money 2 years ago to 20 billion. TalkDesk at a 10 billion. Five9, they've pulled way back, but they're still like 4.5 billion. Nice and Contact, 12 billion. The opportunity, you don't have to look real far to see there is a very, very, very significant opportunity to build very substantial equity value. Remember, of those companies I just mentioned, we're about the same size as Genesys, and on pure, and then we're way larger than Five9 and way larger than TalkDesk. So the opportunity is there, and this is kind of this was the thesis that I had when I came here, and that's what we're executing to. Now we've had to go through a hell of a lot of financial noise to get this result and fix the capital structure, but we're in a super spot now on the other side of it.
No question. So, real quick, what's your sense? On. I mean, you've obviously given some projections, but soft question more. Like, where do you see the culture, as well as Avaya being, a player in the next, 24 to 36 months? You obviously are a believer, and you've shared that, Avaya is here to stay. But yeah, what's some of your vision there, Alan? Over the next 24 to 36 months.
So there is, Steve, as you know, I'm a massive believer in culture. Culture trumps all.
Oh yeah,
yeah. We did, we have a program we refer to as DPTW, Destination Place to Work. Make Avaya a destination place to work, which means it attracts the most talented in the industry. We did the exact same thing at Vonage, and we track it. There's 3 subcomponents: rewards and recognition, culture, and growth and development. And, when I get to Vonage, culture was kind of a dirty word. I mean, it sort of was, think about the bad parts, back, we were hierarchical, very top down. We were slow. We weren't innovative. Not a great place that I think is going to attract great talent. We put in this programmatically, this DPTW initiative, precisely what we've done here. And while it's, I always say it's a journey without destination. So, but while having a great culture is inherently qualitative, there are quantitative ways to measure it, and we do. It's the old adage, what gets measured gets managed. And so if you look at things like, voluntary termination, regrettable termination, engagement surveys, Glassdoor, internal referral, you tell your best friend, apply here, it's a cool place to work. Those were going up and to the right in a big way at Vonage, even in the midst of cutting a whole bunch of folks in the consumer side as we shifted from consumer to business. So you can already see it here at Avaya. We're doing the exact same things, even in the midst of, whacking, we've had to do a very significant RIF in order to get the cost structure in line. So I'm very optimistic on the cultural shift. Now, look, we all know Avaya is, has a lot of people with very long tenures and things like that who may see the world in the old ways. We're making great changes there. And first, people have to have the desire to change and then give them the opportunity to do so. So I feel very good about the culture. And I think our ability to be relevant to our customers, I mean, this innovation without disruption and what we're specifically delivering in terms of the AXP product, the AXP Connect, what we call Avaya Enterprise Cloud to move you into Azure, our own unified desktop plus is resonating really well. And so, I guess if my sales job is to give us a shot out there, because we're here to stay.
For sure. Hey, I meant to ask you earlier, what's the AVANT above you? It says Avaya, and then right next to it, AVANT, I think, if I read that right. On your background.
Why it says, well, I think maybe it's backwards, or it looks like it would have been Avant, but I have no idea why. I have no idea why.
No, that's okay. Hey, well, listen, Alan, thank you. We're at the top of the hour, so thank you so much for joining us today.
Sorry, I blabbed on and didn't take questions. I apologize.
No, actually, I think you stunned us all. I don't think we had any questions. So.
Hopefully I'll see many of you next week. I'll be kind of bouncing around the halls at EC.
Steve, Roberta has one.
Okay, yeah, Roberta, go ahead real quick.
I just wanted to say one of the interesting points you didn't cover is public safety sector, and you already have a lot of the market base, and I assume you're going to be really focusing on that because it's a $25 billion, and they haven't spent their money yet. So it's 7,000 in the US, and they're going to be it's a big pool of money over the next 5 to 8 years globally as they evolve to NG 911. So yeah, and they're just starting the journey. So some free advice.
All right, thank you very much. I'm going to take a point on that.
Where do we?
We're very busy in SLED and things like that, and government in general. But I want to.
Yeah. Okay. And then, of course, everybody. Hopefully, we will see you at Enterprise Connect. We do have a booth at the SCTC. It's actually right in the front this year. Looking forward to seeing you all at Enterprise Connect next week. And again, Alan, thank you for being on. We appreciate your time and your contributions today.
My pleasure.
Thanks, Alan.
Much all. See y'all.
Thanks, everyone. Take care now.
Bye.